us here on Leaders of Tomorrow, ET Now's daily initiative that celebrates the undying entrepreneurial spirit of micro, small and medium enterprises. On the show today, we're in conversation with the new chairman of the IVCA to talk about all things finance as far as you, the MSME entrepreneur, is concerned. Mr. Srinivasan, thanks very much for speaking with us here on the Leaders of Tomorrow on ET Now. Let me start by asking you how far the environment has changed when it comes to both investment and funding in India over the last, say, 5 years.
If you look at from the point of view of funding in India in the last 2 years, let's break it down into two segments. Essentially VC funding, angel funding in one bucket, which is basically the equity class of investments. And then let us look at basically the Mudra scheme and the other MSME lending of the banks. In my mind, this has been a very positive situation in India in the last 2 years, because Mudra is basically opened up a tremendous amount of focus on the existing MSME programs of the government, giving it more meat, giving it more structure and status. Hopefully the RBI will also permit the Mudra Bank to become an independent non-regulator, just like the National Housing Bank. And you will actually get a whole class of unsecured loans going to people who want to start baking, cooking, sewing, delivery of products, or any other kind of MSME business in the services sector or in the small manufacturing sector. In the VC angel space, as you know, last year something like 40,000 crores of funding took place. Three things to look for as we go into the future. The first is essentially the availability of funds for VC funds in India from the domestic side. The government has launched a very commendable move by creating a fund of funds, which they call as a Startup India Fund of 10,000 crores. I understand more than 1,200 crores of investments in VC funds have been made, subject to them raising about 3 to 4 times that amount, which means effectively you've created 4,000 to 5,000 crores of Indian VC funds. So that, I think, is one important trend. The second important trend is basically the entire small finance banks who are moving away from JLG alone, joint lending groups alone, as their primary lending mechanism, because JLG loans are basically often consumption loans, often working capital loans, but essentially moving more into UMEL and RMEL, urban micro enterprise loans and rural micro enterprise loans. As you know, the entire microfinance, small finance bank sector puts out about maybe 10-15,000 crores, and this is my broad estimates, of money into the industry each year. And all of them have been freshly capitalized with a few thousand crores. So there's a lot of money going to be available in rural micro enterprise and urban micro enterprise sector. And I think the third thing is, of course, the ongoing focus on Mudra, which the government has targeted 2 lakh crores this year, up from 1 lakh 10 or so last year. There is always a criticism with Mudra saying it is reclassification, but even so, the fact that $32 billion worth of funds are going to people borrowing 1 to 10 lakhs of rupees to start businesses, I think is a very, very important trend.
So we've spoken about how things have changed over the past few years, but if I can ask you to do a little bit of crystal ball gazing and tell us what you think are going to be some of the major changes over the next 5 years.
The creation of Mudra as a separate regulated enterprise, giving far more flexibility in terms of the kind of refinance channels that the Mudra banks, the public sector banks can use. That could definitely be one major change that the government can bring about in a regulatory framework to encourage people. Another important change can be, today there is a cap in terms of how much spread a bank can make while refinancing a Mudra loan. It's a base rate plus 6%, if I remember correctly. Actually, the costs of giving these loans are as high as 10%, 12%. In other words, in the banking industry, we talk about cost-income ratios, and they can be as high as 60-70% for small loans. So permitting small finance banks to be treated like microfinance institutions and allowing them to charge much more practical rates when they lend money is something I think that the government could look at, because that's again a regulatory decision of the government to basically allow greater spreads to SFBs when Mudra Bank refinances SFBs. That could definitely be another positive step in terms of financing. The third positive step I think which is necessary is there is this feeling among the press, which is created by the press, which is fundamentally that venture capital is the only source of funding. I think we need to sit back and calmly analyze that venture capital is a class of capital that demands typically on successful investments 50 to 100% IRR for 3 to 4 years, because of the fact that 6 to 7 investments fail and only 1 or 2 succeed dramatically. Is how many companies can produce equity returns in their valuation of 50 to 100% for 3 to 4 years is very, very, very few. So we have to go away from venture capital to more a mezzanine equity, mezzanine debt kind of model, where in addition to for the micro enterprises, the small finance banks and Mudra type of financing, we also end up getting more quasi-equity financing, where basically people could take money for 2, 3, 4 years interest free, and then at that point in time convert the money, convert into equity or repay it as debt.
There seems to be a trend of late, Mr. Srinivasan, domestic funding activity seems to be picking up, and a lot of entrepreneurs and startups, I noticed from reports, are raising money only and almost entirely by domestic PE and VCs. Now, is this a trend that you think will pick up steam, or do you think it's very early days yet?
Very early days. Let's look at numbers. If you remove the VC funding, the mega VCs and so forth, let's say that about 1 lakh crores were invested in the sector last year. Total domestic raise might have been 8 to 10,000 crores, 10 to 12%. Money deployed by Indian managers, including foreign money and Indian money, would have been about 30,000 crores. So there are two ways to analyze it, Sunanda. One is to say India domesticated managers who are using AIFs and other structures, how much did they invest? They invested about 25 to 30% of the total investments. How much of the total money came from India? It's 10 to 12%. So clearly it's early days. As I said, the government's move to create fund of funds, they have created SIDBI, and they should create other alternative systems to give money to Indian fund managers. I think it's just the beginning. Who has the money? There are monies located in 2 pools in India. HNIs can invest, as per our calculations, if you assume that HNIs invest only 3 to 5% in alternate funds, they can probably invest about 1.5 lakh crores in the current market over 2-3 years. So that's about $10 billion a year, if you want, or $8 billion a year. Second, EPFO, unbelievably large resource. For EPFO to come to the market, we must commend the current chairman of PFRDA, Mr. Contractor, who said by this March 2 to 3% of the private pension, which is a very small part of the national pension, will essentially be available for investments into the into AIFs. So that I think is the other early green shoot of this. The third green shoot is a breakthrough decision of the government in February to allow dollar money and rupee money to be pooled in the alternate investment fund structure regulated by SEBI, and the money coming out of it treated as rupee money, provided the manager is Indian owned and controlled. It's a breakthrough step. So imagine tomorrow there's an e-commerce company or a retail company who needs rupee money because of FDI policy. Any money they take from an AIF that's managed by Indian owned and controlled manager automatically is treated as rupees, even though that AIF may actually be having dollar money. So in some sense the government has created this new class of rupees which is actually is dollars. And I think that's a fabulously innovative step of this government. And I think you'll see the impact of it perhaps. See, it takes about 18 months for a fund to close. So look at it by March 18, and I think you'll see some very interesting numbers.
If I can ask you what reforms you'd like to see, if such activity is going to be more sustainable, you're saying it's still early days yet. So is it possible that regulation maybe could change the pace of domestic funding?
In the regulatory sphere, I think less and less needs to be done. It's more and more markets. So in the regulatory sphere, one had to look at it. One would pinpoint three changes. First is that the tax code has been greatly evolved and reformed by this current administration, but there is one critical step left. In funds, we primarily invest in unlisted companies. Now, unlisted companies, when their shares are sold, the government has given a clarification that they will be treated only as capital gains if held for 2 years or more. It's a very positive step. But somewhere in the fine print, they've also said if management or control are transferred of that company along with those shares, it is left to the assessing officer to decide whether it is capital gains or any other type of income. Of course, there was a good reason for which they did it, but that reason may not be relevant to AIFs. This is a cause of alarm for this industry, that fundamentally the tax code can, shall we say, be inconsistent, or shall we say more correctly, uncertain. We want constancy, we want consistency, and we want certainty in tax code, the 3 C's of the tax code. So the second regulatory change is with the domestic pool regulators. PFRDA should accelerate 5% into AIFs as fast as possible. EPFOs and private pensions should be encouraged to invest in fund of funds. The government, as it's creating the SIDBI fund, should also try to partner with, say, an IFC or with, let us say, a Canadian pension or those kind of organizations to create dollar-rupee fund of funds which can be invested into India. On the SEBI side, I think there is an important weapon that SEBI has sort of flirted with the industry by showing, but not really allowing us to use that very powerful tool, and that is the angel fund network. How long you can take to invest the angel money, or what is the minimum investment to be made in a company, or what is the minimum hold period in a company. We believe that SEBI should not regulate those things because those are market-driven dynamics.
All right, Mr. Srinivasan, do hold that thought. Let's take a very quick break. Much more on the other side, though. Don't go anywhere. Welcome back. You're with us here on the Leaders of Tomorrow, and we're in conversation with the IVCA. Now, you've taken over as the chairman of the IVCA earlier this year. What are some of the key strategies, plans, or the broad framework that you hope to see achieved this year?
At IVCA, we have one simple goal. We wanted to make it very easy for investment managers, whom we call GPs or general partners in the industry, to start a fund, to raise a fund, to invest a fund, to manage the fund, to exit successfully, and make investors get their expected returns. So this is what we stand for. So everything we do is oriented towards making life easier for GPs, new GPs, spin-offs from other funds, people leaving big funds, foreign funds, starting their own Indian funds, which is a big phenomenon of the day. So we have taken up 2-3 initiatives. One initiative is to address the needs of all the sub-asset classes. Within the AIF asset class, you have real estate, you have emerging the credit and stressed asset funds, the VC funds. You have a group of people who says, manage in India, we want to manage in India, make it easy to manage money in India. We have basically people who are worried about the capital pools. So we've actually formed 5 sector councils from leaders with this industry. So we have tried to widen our footprint and represent more than 80 to 90% of the checks written in India, and start addressing the issues at sub-asset class level rather than generally at AIF alone. That's one thing we do. Second thing, we work very closely with SEBI. There is something called the Alternate Investment Policy Advisory Committee. IVCA's leadership played a very big role in supporting Mr. Narayan Murthy's excellent efforts in coming out with the IPAC report last year. We are now working on the addendum of the report. There we talk about new themes like greater focus on raising money into Indian funds. How do we raise more money? How do we make it easy for LPs to invest? What kind of transparency, what kind of governance, what kind of performance data about the industry would make it easier for them. Secondly, we're addressing issues around basically the creation of permanent capital vehicles, which is basically listed funds in a very simple way of speaking. So that is something we've taken up strongly with SEBI, and we're adding it to our second report. So that is the second area of engagement, of creating long-term roadmaps of vehicles that can greatly enhance fund flows into the industry. And lastly, we've taken up this permanent issue for us, which is simplifying the tax code. And in this particular case, the one I shared with you about unlisted shares, there are still issues remaining about 56B2, or is it 56.2B regarding valuation. There are issues relating to, for example, AIFs having 1 year lock-in in IPOs. So those continuing narratives on the same thematics continue with SEBI.
Now, the government, of course, on its part is actively wooing IT companies, whether it's Digital India, Make in India, Skill India as well. In your opinion, how do you see MSME entrepreneurs, whatever is the industry vertical they are in, participating more in such government initiatives?
In my mind, if I was the MSME stage right now, I wouldn't like to see how to focus on government programs as a primary way of designing my business. I would rather be driven by any market opportunities, including those created because of the government stimulus. So for example, if one is to take Skill India, if you were to be a training organization, you're very keen to become a skilling organization, or you want to be a finance company helping people who are acquiring skills acquire payment, or you're a digital company creating training management, content delivery systems, or you want to if you want to become any of these three, yeah, then go and look at Skill India as a way to get money and get opportunity. But similarly, if you want to be in Digital India and you want to benefit from Aadhaar driven service centers or opportunities, or UPI driven opportunities, that's fine. But I think the primary thing MSME enterprises to do is look at what is it that they're good at. Ultimately, the person doing that must be really, really good at something. And that's the opportunity they should seek, where that strength that they have will create economic value and customer satisfaction. So that is where I think they should concentrate. If in that process, elements of Digital India like say eSign, eLocker, Aadhaar can be leveraged by them, UPI can be leveraged by them, if they can acquire skilled, trained people through Skill India missions or Skill India training development centers, that's fine. These are to enable them to succeed in their business.
What advice you have for our viewers in terms of how they can go about raising funds? How easy or difficult is it, in your opinion, for them to raise funds, whether it's banks or venture capital? What advice do you have?
I think for a normal MSME entrepreneur doing business, the most important way to raise funds in the beginning is to use your own capital, use community capital from others, use as much of the programs available like Mudra and other MSME schemes as possible in an area in which you have core strengths. Do not use passion as a way to choose your model. Choose expertise and capability as a way to choose what you want to do. Passion will come because you're good at something. You don't become good at something at work because you're passionate. That may be when you're younger. So choose things you're good at, use the traditional routes of earning money, focus like crazy on one thing, just one thing. Don't try to get distracted, because when you're trying to do that one thing and you don't get revenue or you don't get good pricing, you say, no, let me try B, C, D. You have to make A and B work. Or if A and B is not working, dump A and B and just do C. That's also fine. Nowadays the word is called pivoting, but pivot if that's what you need. But I would say do what you're good at, focus on one thing, use community capital and traditional forms of capital, and then only worry about the very, very expensive forms of capital like VC, PE. Many entrepreneurs chose VC as a way of funding also because it was like cool. I am from IIT, I'm doing something cool in the tech space, and let me convince somebody to give me money. In my mind, it became a lifestyle. to some small extent. That lifestyle part probably got exaggerated out of proportion, unfortunately, as the way it is in the press. But I think my recommendation is just these three. Do what you're good at, focus, and use community capital and bootstrap yourself. Then go to more institutional funding like Mudras or MSME or UMELs, RMELs. And that is the way for 99% of us. For the 1 or 2%, in the early to mid stage, maybe you can take VC money, but that I think is the most expensive form of capital, and it only works in a very narrowly defined area. And there it works very well, extremely well.
Gopal Srinivasan, thank you very much for speaking with us here on the Leaders of Tomorrow. Completely out of time on this episode, but do remember that if you want to write into us, give us any feedback, you can do so. The email ID is leadersoftomorrow@timesgroup.com. You can reach us on social media using the hashtag LOT or call us on that number you see on your screens. Thanks for watching. Have a good night.